Hello and welcome back to the Modern CFO podcast. I'm your host, Andrew Seski. Today, we're joined by David Magerman, who's the co-founder of Differential Ventures. David's also been an investor for decades at some of the most storied and famous funds, and also has been doing research for his whole career. So I wanted to kick this podcast off, and we're going to have a great time going from IBM to Renaissance to how you're thinking about investing today. But I want to go back to early research days of what was most compelling to you at that time and kind of brought you into the world of both research and how that led into your very storied past of investing.
Sure. So I started out my career really as a computer scientist. I was at University of Pennsylvania as an undergrad and got very interested in natural language processing. But I wasn't very interested in the traditional approaches that people were taking with grammars and rules and semantics. And I was interested more in mathematics and statistics. And so I did some of the early work in using data-driven kind of statistical analysis of language to try to understand sentence structure. And what I learned from that was that there is a certain amount of information in data. And there are lots of ways. I learned a bunch of different methods of learning models from data. But either there's signal there or there's not. And there are ways there was data that was being ignored, which could be really valuable, and trying to find ways of harnessing that data. And there were some kinds of information which just weren't present in the data. And so when we were trying to use that sledgehammer of statistical analysis to solve certain problems, there were some problems that just weren't solvable, either because we didn't have enough data or we didn't have the kind of data that you needed to solve the problem. And so when I was at IBM Research doing further work, finding in machine translation, speech recognition, and natural language understanding, we faced a number of problems which were really unsolvable with the technology we had and the data that we had. And we really felt like a bunch of us at IBM felt like we were maybe a decade too early for the kinds of techniques we were using. And so a few of the senior team members left and went to go join a quantitative hedge fund, which kind of wasn't a thing at the time. This is the mid-90s. I certainly didn't know what a quantitative hedge fund was, much less a hedge fund. And after a few years at the hedge fund, those IBM executives that went there started bringing some of their IBM research team to join them. And I joined Renaissance in 1995 on that little exodus.
So this claim to fame that you have for bringing some of the more structured engineers and computer scientists into the world of investing, what did that look like in the early days as the data was just becoming available and some of the more structured engineering teams hadn't really been moved into any sort of quantitative analysis for the markets?
Right. So when I joined Renaissance, Jim Simons, the founder of Renaissance, and he's a very famous mathematician, considered maybe the most important American mathematician of the 20th century. He had this idea to use statistical modeling and systematic trading, first in the commodities and the currencies market and bond markets. And he was very successful with that. But he had put together a team of mathematicians, information theorists, some physicists, and they were technologists to the point they could build a system, but they weren't trained as computer science engineers. So they didn't have certain kind of methodology that was standard practice in the industry. And they really were kind of gluing together systems, making a lot of money at a low risk. But it was hard to scale a system that wasn't well engineered. And especially going from commodities and currencies and bonds, which have dozens of instruments, and going to equities where there are thousands of instruments, that scaling problem was really significant. And Jim had been banging his head against trying to build an equities trading system for a number of years. And when the two executives from IBM, Peter Brown and Bob Mercer, when they came to Renaissance, they brought that engineering, computer science mentality. I think Bob was a physicist, but Peter was a computer scientist. But we had learned a lot of kind of rigorous coding practices and software development practices and research practices at IBM, and they wanted to bring those there, first to the equities group. But then when I joined, I was very much an infrastructure guy, really a software engineer, and I wanted to kind of terraform the company to adopt better practices. So the first thing I did was encourage everyone to learn C++. We brought an instructor in and taught everyone how to program in C++ with object-oriented programming and some of the buzzwords of the time. And we upgraded some of the other tools that they were using, and basically tried to institute better software development practices so that we could track the improvements that we were making to the system systematically as opposed to anecdotally, which is the way it had been done. And Peter and Bob had brought in a number of the kind of research methodologies that they used at IBM very successfully and kind of imprinted them on at least the equities group, because that was really all we were working with. And then when we became very successful after maybe 5, 6, 7 years, and we were maybe making 3/4 of the company's profits and trading most of the capital, then we eventually kind of moved ourselves over and started imprinting our modeling on the commodities and currencies and bond part of the company, rewriting their software in our in the systems that we were writing them in, and then starting to do some of the research practices that we were using in equities in those systems. And I think that epoch of transition helped kind of unify the company, under a certain code base. There was nothing, we didn't change the models per se, but we changed the engineering infrastructure, which I personally think is kind of like a big part of the success of Renaissance.
Interesting. When you're taking such a novel approach, do you think that because you were coming more from a computer science background than financial, you mentioned that narrative and the stories around these companies were driving a lot of the trading volume at that time. Do you think having that outside perspective was helpful in trying to not only build something very novel, but also not having the reflex of very human errors trying to correct something that might be halfway built or not refined as a model?
Well, I think actually that was part of Renaissance's whole thesis, which is that not even just the computer scientists, but no one at Renaissance came from a financial background or economics background. If you had an MBA or a finance degree or an economics degree, you weren't qualified. You were disqualified from working at Renaissance. They really wanted deep scientists who'd done PhDs in experimental areas, astrophysics, particle physics, different applied mathematics, areas where you did a lot of number crunching and where rigor and scientific validity was really important to your work, because they wanted to, like as you pointed out, they wanted to bring in people with very unique and creative perspectives on the data, the financial data that we were looking at. They didn't want kind of a staid kind of Wharton perspective on financial analysis. They wanted to bring in different perspectives, and having an astrophysicist looking at the data, thinking about planetary motions and looking at the movement of stock prices the way you'd look at planetary motions, or people who study subatomic particles and thinking about the physics of that and how that can help you understand how stocks relate to each other. Those are the kind of mentalities. And then bringing in people who had algorithmic abilities in computer science, who understood how to take complex mathematical formulas and encode them efficiently and experiment with them in kind of a time-constrained and resource-constrained environment. So all of that played into the different dimensions of how Renaissance became successful.
So there was a core group of IBM researchers, and you were one of them. How did you go and attract all of these different types of people that you thought were going to be really helpful to try to be qualified to be a part of this kind of elite team, trying something pretty novel?
Yeah, I mean, look, there are people who wanted to come, especially once our success was more renowned, people who wanted to come work for us. So, we got a lot of candidates interviews, but a lot of it was really word of mouth and social connections. We all had connections in faculties of, science and math departments in different colleges, grad schools, and, someone in an applied research area that had a candidate that was particularly brilliant, that that might be willing to go the route of financial engineering as opposed to pure science. There was a lot of networking where we believed in the credibility of the candidates because of their thesis advisors or colleagues that had worked with them, their publication history. But there's a lot of vetting that went on, and there was definitely a word of mouth aspect of it, where knowing someone who worked at Renaissance or knowing someone who knew someone there was a big leg up if you were qualified.
What were some of the earlier days like in terms of trying to be competitive? We've had a conversation now a couple of times about when something can hit a critical mass to become competitive with the established firms. What did it look like to hit that kind of critical mass and be more competitive at Renaissance? Was that like, all in a couple of years, or did it just take a while to continue to grow and grow and grow?
Well, I mean, it was a nascent field even when we started. The field of, we were doing electronic trading, which we were kind of like at the forefront of that. We were usually like helping the electronic trading venues debug their interfaces by us, stress testing them with our normal daily volume. So there was definitely a lot of that. But the truth is that there were some well-known names in the industry, but they tended to have this pattern of starting up a strategy, having it work for a while, having a rough patch, losing faith in it, and then shutting it down. And whereas Renaissance, instead of having like 10 or 20 strategies, kind of had one monolithic fund, the Medallion Fund, that operated kind of as one entity. And there was no notion that you were going to shut that down. It was kind of a continuous operation. And I think that continuity over time really helped Renaissance just establish itself relative to competition, because every time you shut a group down, probably in 2 or 3 years, you're going to start up a group which is going to look roughly like the one you shut down from scratch, and the lack of continuity is going to make those two pieces less valuable than if it had been running through the entire time.
So just switching over to learn a little bit more about Differential, some of these core computer science competencies that you've been able to refine over decades of investing, you're now doing in a very different form in your private investing world. So what are some of those, what are you looking for in some of these other technologies, and what's exciting to you today that isn't really something that's part of your passive public equities investing?
Yes, I look at my whole career, from my computer science PhD focused on artificial intelligence, where I learned about the history of the decades of overpromising and underdelivering of AI technology, and then going into this kind of deep dive into data science and deploying statistical models in day-to-day real-world problems, trading in different markets, and having lived through the behind the scenes of how to build those models. How to build them wrong in some cases and build them correctly, build them well, how to watch them and monitor them and track them as they sometimes don't work the way you expect them to, and then eventually seeing the engineering successes over a long period of time. The combination of those experiences has really informed my investing at Differential, more so than like anything specific that I learned. There's not a lot of crossover between quantitative trading on kind of a relatively short time scale and investing in early stage companies that have no data, investing on a 10-year time horizon. So, but really what I've learned about the value, the places where there's value in technology and the places where there's glitz, is really kind of a key to how we analyze the market. So a big area of investment right now, the last few years, has been artificial intelligence, particularly deep learning and neural networks. And what I learned about data science is really fundamentally it's about information theory. Like, you have data. Is there information in there that you can pull out of that data? If you had an oracle and you could pull the information out of that without any noise, and then could you solve a problem with that information? Is there really signal in that data to solve a problem that you actually need to solve? And then, so once you know that, if you believe it to be true, then there are a lot of different ways of pulling that information out. So neural networks, deep learning, is a lazy way of doing it. And that laziness has a value to it, because you don't have to have a lot of domain knowledge or expertise. You can throw a neural net at a data set and not know a lot about the intricacies and structure of the data, that the neural net will kind of discover the structure in its hidden layers. So I say lazy, not necessarily in a negative connotation, but there are harder ways or more ways that require more work that may be more effective at pulling data out if you know what the signal is. And so seeing, we're looking at companies that are pitching, almost every company is pitching that they're doing AI, even if they're not. And sometimes they're talking about AI that they haven't implemented yet, working on data sets they don't have yet. And so all those things are warning signs for us, because if you don't have data, you can't know that you have information. So if no one's ever collected the data you're talking about, then no one knows if there's information in there. Right. And then if you haven't built the machine learning systems to pull the data out, then we don't know that you're able to do that. And it's a kind of a core competency that you have to have some ability to implement a software system. So there's like a lot of layers of just understanding what can go wrong with data science. Things that I've seen at Renaissance, things that I've seen in the kind of natural language and speech recognition world, where if you're presuming there's information in a data set, that's a risk. And if you don't know whether the information you're extracting is actually going to help you solve a problem, as we found many times with natural language processing, we did all this analytical work trying to understand what a sentence meant. But if we couldn't translate the meaning of that sentence into an action in the real world, like helping someone make an airline reservation or helping someone like get a route, a traffic route, things we do now, we take for granted now that we can do that. But back then, we didn't have the right technology to do that. And so even if you could solve the piece of the problem that was solvable, if you didn't have the rest of it, then you were kind of like, building half a bridge.
Right. One of the things that you mentioned is that you feel like the promise of AI has not really been fully realized. Or I'm wondering if you think that that's a function of maybe some of the work that's being done. You said you can identify pretty easily when mistakes are being done from the engineering side. But I'm also kind of curious if you think on the financing and investing side that maybe we are still focused too much on glitz as opposed to core value. So are we... is that a result? Are we financing innovation without enough diligence, or are the VC dollars just being spread too kind of casually across so many different types of early stage companies that we just don't see the right founders getting the right backing to drive value?
Yeah, I mean, definitely there's a gap in the venture funding process. That's something that we think at Differential we've helped to ameliorate a bit. That you have venture analysts, principals, investment professionals at funds that are taking meetings with founders, and the founders know who they're talking to. Typically, they're talking to non-technical people.
Right.
Some of them are superficially technical, but not deeply technical, and certainly not practitioners of AI and data science. And they can pitch an idea, pitch the thesis of their company in a way which is impenetrable to a non-practitioner. So, we see so many companies that we have one or two meetings with the company, and they're an AI-focused company deploying AI in cybersecurity or supply chain management or some other area, and they have some unique IP, some way of approaching the problem that's unique, and it's going to be differentiated, and they're going to beat their competition, and so on. And then I sit down with their CTO and maybe one of their lead engineers, and I start asking them about their code base, the systems they use, what they've built versus what they still have to build, what data they have, what tools they're using to extract models from the data. And literally half the time, they have none of that. They don't even have anything implemented. They have no code. They have a rule-based system that they're eventually going to replace with AI. And that's a warning sign right there. But also there are times where they have a data set and they have someone who's analyzing it. But if you look at the background of we don't always get to talk to the data scientists, but we're just talking to more the executive level. But when you look at the credentials of those people, there isn't a believability that they are going to be able to build a best-in-class system to solve a problem that's never been solved before. Because typically these are people deploying AI in areas that haven't been successfully deployed in. And it takes a practitioner to get under the covers to ferret that out. Otherwise, what you do, like you said, glitz, there are certain buzzwords that are popular, and people want to have a certain amount of AI in their portfolio. They want to have a certain amount of this kind of AI, be it data science, federated learning. There's different buzzwords, and if you know what's in vogue as a founder, you can pitch somebody and get them excited about it. And then there's a competition, and there are a lot of large, maybe $250 million, $500 million early stage funds that do the spray and pray, where they can invest at the seed stage or the pre-seed stage, and they can kind of throw money around and wait until the Series A, and whoever's still around by then they can really focus on helping them. But there's a lot of kind of like hands-off management of the early stage, which is really dangerous. Companies need guidance, but also if you invest in an empty shell with a promise of something, then the odds are it's not going to materialize without a lot of support. So, we try to focus on companies where they pass that sniff test or the analysis test of having substance from the start.
Right.
Or in the case of some of the pre-seed investments where the team has a proven track record of being able to build the technology that they're proposing to build. So they haven't done it yet, but we can see from either their academic work or from their previous startup work that they have the raw ability to do it. And we believe that the modeling part of it is going to work out. But that the problem we've seen in the past, which hopefully is going to change in the present and future, is that so many of these idea companies without substance were getting such rich funding at such high valuations at the pre-code, pre-product level that we couldn't really be involved in that market. We're a small fund. We're investing. We're going to be very hands-on with our teams. We invest in them, but we're investing for value at the early stage, and we couldn't play that kind of pre-product gamble kind of a game. So we would look at the less glitzy companies, the ones that were in more mundane sounding areas, but had really exciting technology that I could identify as being valuable, and hope that no one else saw the diamond in the rough.
Yeah, it's really interesting. I was just thinking about how there's not a venture capitalist out there who would claim to not be hands-on and founders first, and there's all these kind of this VC vernacular around trying to be useful outside of the venture dollars, because the venture industry is set in the business of selling their money,
Sure.
their investors' money. So I think about that, and I wonder now, because there's such a clear investment thesis of how Differential can be just such a clear value add as a partner for founders, not just outside of the financing as well. Mm-hmm. So is this these funds purely seed, or are you going to look at a range of stages for these companies?
We're focused on pre-seed and seed. Seed has like a couple of different levels. There's usually like an early seed.
Right.
There's kind of like a seed, and then there's the seed plus, the seed extension, mm-hmm. where some companies need a little bit more runway, and we'll invest at all those. We'll invest in that extension if we see a lot of value in the technology in the company. But you're right about the buzzword of founder friendly and hands-on. That's something that anyone can say. The thing that we're seeing from our Fund 2 investments is that a lot of our Fund 1 portfolio company founders are recommending us to their friends in the venture world, and we're getting a lot of organic deal flow from really good founders, really good, better opportunities than we had been getting before in some cases, because they're really smart founders that would be really in demand if they put themselves out on the market, and we're getting first looks at them because they're being recommended to us as a founder-friendly venture firm, and someone that we care about all of our companies, that we're not going to let any of them kind of go off and drift for 6 months or a year and then check back in with them. We have anywhere from weekly to monthly meetings with all of our founders. We are all hands on deck. So my partner has some companies he's the lead on, but if they have a technology problem, they come to me. I have companies that I'm the lead on, but if they need, he's a sales and marketing expert. If they need sales and marketing help, they'll go to him. So we have like a holistic team that we kind of will move around as companies need it. The thing that I've been most surprised by, although it makes sense to me after the fact, is that my technical knowledge as a practitioner is not valuable in the way I would have expected. If we invest in an early stage company and they need my help with data science, we probably shouldn't have invested in them. Like they should be expert, in their team, more so than I am on the domain of problem they're solving. Where I've been able to help them is as they're growing their team, having lived through Renaissance's growth from effectively a startup to a large corporation, and having experienced different kinds of group dynamics working in different parts of the company, I can help them with hiring, with identifying the right qualified people, helping them triage the staff that they have and identify weaknesses in it. And also, as they're growing, there's cultural growth pains that companies can have, and I can that it's different on the corporate side and on the sales side than it is on the technology side, and helping companies understand how to manage technical staffs and the personalities and egos and things like that. I think that's something where I will be adding a lot of value down the road.
So you're doing that with some of the portfolio companies. You've done it at Renaissance. Tell me about how you're building the Differential team itself and doing all of the same modeling how your culture is going to grow and expand as well? Because you mentioned you're up to 6 full time. Yep.
Right.
So as you're working with some of the portfolio companies and assisting there, how are you thinking about it as a fund and a growing team?
Yes, I mean, we're actually actively hiring right now, going through a process. But one thing I learned at Renaissance is that to hire opportunistically. So, at Renaissance, there were never really any roles to fill, but we were always hiring. In that, if you meet someone that just is a smart person that you think complements your team well and can add a lot of value, suddenly there's a position available for them.
Right.
And you hire them. And so, from the start, I realized that Nick and I were not going to be able to run the firm ourselves. And even though we were a startup firm with very little AUM, I invested a lot of money in the management company, hiring a team, making sure we had an office, making sure we had pitch book, we had CRM. I wanted us to operate like a fund 3 or fund 4,
right.
and invest in the business. So we hired people, we hired an analyst early on, and we've hired now some associates. We promoted one to principal, and now we're adding more to our team. But the idea is that Nick has extreme abilities, extreme competencies in certain areas. He's got a lot of experience as a sales and marketing expert, go-to-market strategy, business development. He was involved in startups as a team member, leading sales teams, and then he was a venture investor before starting Differential. I have this deep technology background, understanding and being able to research technologies I don't know, and having a lot of experience seeing how technology develops and evolves and how to build it. And now we have our principal, Ned Berman, who's been more at the later stage investing in corporate venture, who has a different experience, different background, also a technical background, but not the kind of practitioner that I was. And we're now looking to add more dimensions to our team. So a lot of people like to talk about diversity in hiring. For me, that translates into diverse skill sets. And I don't want to find another computer scientist that will just, add deeper depth to our technical abilities. I want to find people who have exposures to other industries that we don't have experience in. We've been very interested in space, in health technology, which we don't have a lot of expertise in. We've been interested in shipping technology, things like that. We're definitely interested now in Web 3.0 and some of the metaverse and things like that. And so finding people that have, and of course, metaverse, not a lot of people with deep experience there, but
right.
but trying to find people that will complement our strengths and add to them, and not just reinforce what we already can do. And if we can find people that have that, that ability to add dimensions to our team, that's where we're going to hire.
It's probably been sort of difficult, at least, to keep culture ingrained, being, remote and maybe hybrid now. You said you've got, made sure that you want to have an office for everyone to go to. What were some of the kind of things or anything that maybe listeners can try to mirror that were helpful getting your team to stay, conducive, hardworking, and be able to kind of over communicate, where it's needed? Yeah,
I mean, I think that it's an evolving situation. I've been telecommuting since 2010 because I moved from Renaissance to Philadelphia, and I was working in Philadelphia for Renaissance remotely full time since 2010. But and I've been commuting into New York since doing Differential. We've had an office, and my partners actually were going in through all of COVID. They were going in. They both lived right near the office and were physically coming in. And the rest of the team was remote. But I think the fact that the lead people were in there physically, just trying to hold up the fort. And we've also had a couple of close calls with some investments. The first time we did an investment without meeting the founders in person was a very nerve-wracking experience. There's definitely something about shaking hands with someone, taking them to dinner. After a meeting, just shooting the breeze with them, you learn a lot about the nature of people, and I think that dimensionality is really valuable for evaluating a founding team beyond the nuts and bolts of their pitch book, their pitch deck. And so we didn't have that anymore, and so there were a couple of times where we got late into diligence with teams, and maybe had a Zoom call with them where after the call was over, we hung out for a while and just chatted about stuff, or there was some contentious conversations where we had to really go off script and really kind of hammer in on issues. And then we saw the true colors of some of these people that were not the kind of people we wanted to be in partnership with for 5 to 10 years. And I think that's something missing. And I think having those anecdotes and having the people that work with us that have lived through that, it reinforces the idea that we can do a lot of things with technology and we can do a lot of things remotely, but there is a value to human interaction, and we impress that upon everybody and we try to encourage it. And there's also a value to the dynamic of sitting in a room, talking about a company, talking about an investment opportunity, getting a coffee, coming back, having two people talking and then a third person joins, overhearing a conversation and joining it. That dynamic is totally missing from the Zoom culture. And the more we work in person, the more we see just the benefits of that. So I think it's, we have to be flexible. I'm very old school and think everyone should be working in an office and working in person. And I know that's not going to be the case forever. That's been permanently changed by COVID. And there are some teams which can work as effectively, or in some cases more effectively, working somewhat, hybrid or remotely. But I think that we ought to be thoughtful about, for our portfolio companies and for Differential ourselves, be thoughtful about what things we need to be doing in person or we'll do better in person, and what things we can either get away with or actually benefit from being able to do remotely.
Are there any common mistakes founders are making fundraising right now? It seems like the conversations that you're having, there's a lot that goes into a fundraising conversation across the pitch, the evaluation, how they're conducting themselves, all of that being taken into consideration. Have you seen sort of kind of common mistakes that are being made? I know there's probably a list out there of 1,000 things to or not to say that's just right for a fundraising meeting, but are you seeing anything that kind of stick out, or any advice for some of the founders who may be actively raising right now in kind of an interesting market that maybe is getting shaken up a little aggressively as we speak?
Yeah, I mean, first of all, I would say that I flip it on its head and say venture investors need to meet their founders where they are. And it can't be a cookie cutter script of an interview for every founder, every company. There's a dynamic that you have to as an investor, understand who you're talking to, try to read the room and figure out what kinds of questions to ask and how to structure things. I mean, I'll sometimes stop a pitch and just get them off their script and just start asking them questions midway, because I realize they're going to use up all the time reading a script, and I'm going to learn nothing, and I'm not going to invest in them, and there may be something there. So if you pull them off their script and get them, thinking on the fly, you can get them to be more authentic and learn more about what they're actually doing. So I think there's an element of that where it's a two-way street. We all make mistakes, and we all need to accommodate and forgive the mistakes of the counterparty, but also try to work through them. But I think that a lot of investors are immune to the buzzwords and almost tired of them. We see a lot of pitches. We hear the same words over and over again. And I think that the main things that we're looking for is, what do you have that's fundamentally different from the competition? What problem are you solving, and why is that problem being solved valuable? It's amazing how many pitches I'll get to the end and I don't even know what problem they're solving. I know what the technology they're using. Right. I know what they call their product. I know what their pipeline looks like, but I don't really understand what problem they're solving. And then I can't figure out, is that problem valuable to be solved? And if there's a downturn, are people stop caring about solving that problem? So understanding, the what problem is being solved and then motivating why it's valuable, I think are really important things. People spend way too much time motivating mundane problems. Like there are certain things like that we've heard, 300 pitches about people trying to solve this problem. You don't have to spend 15 minutes motivating it. Right. So I think there's unless you're solving a problem that people don't understand, in which case you should. So I think there's that nuance of knowing your audience on both sides. The VCs need to understand and learn who's speaking to them and how to get information out of them. And I think the founders need to research and read the room and understand how, if you've had a successful exit in a company that does something similar to what you're proposing to do, you don't have to do that 5 to 10 minute, pre-pitch of what the industry looks like. So I think that's the and it does bore us, that we can zone, especially on Zoom. It's really hard on Zoom, but it's you can zone out. So I think it's just really viewing the counterparty as a human being with dimensions and trying to tailor the pitch to as much as you can figure out about that person ahead of time, and as much as you can learn about them in real time to make it a dynamic conversation. Because I remember the dynamic conversations. I remember the personable founders. Even if we didn't invest in them, I could remember them, and if they contact me in 6 months, I'll remember the pitch and maybe I'll invest in them then. But if you just do like a script and you read and you're done, then you're 100% banking on the investor understanding the value and choosing to invest purely on the paper.
Right.
And that's not giving yourself enough credit if you're a person that has dynamic qualities.
I'm thinking a little bit about what may transpire if there is a pretty aggressive downturn in some of the private market valuations, and maybe we will see a bit of a shakeup of some of these companies who kind of relied on the ideas of technology without having a problem to solve, maybe with a square peg in a round hole, which is now a very expensive peg. But it might be interesting to see what will transpire across even the next couple of years. But makes me think, what makes you most excited? What's exciting you that you think is going to take place in the next year or two, either from a technology, maybe it's AI being slightly more fulfilled by more unique teams that you get to finance, and then maybe just broadening out a little bit further into next 3 to 5 years. Be kind of interesting to see what lights you up the most, either for the fund or to finance some of the really interesting ideas that are coming across your desk.
Yeah, so I think on the kind of downturn impact, what I'm most excited about is seeing efficiency and rationality returning to the markets. It's great if you can raise $10 million on an idea and have build out a team of 30 people, in your first 3 months to compete with the later stage companies like out of the box.
Right.
But I personally don't think that's the best way to build a stable company. I think the idea of having a small founding team running on a shoestring, building a bare bones proof of concept, getting funded to build an MVP, growing your team slightly, building out your culture at the same time,
right.
But being lean and mean and being always being aggressive and always trying to squeeze the most value out of your team and your time and your technology. To me, that's been missing in some of this surge in early stage funding, where people don't go through that exciting period of getting to that next plateau on a shoestring and proving yourself and being really hungry. And not to say that these founders aren't hungry, but it's just hard to be thoughtful about resources when you have an overabundance of them.
Right.
And especially if you've never been a founder before. So I think it's a really hard problem for someone if they're given too much resources. So I think I'm excited about the frugality that's likely to come into the market at the early stage, which I think will be very healthy for the market. And in terms of technologies, I think there are some fundamental brick walls we're running into. Moore's law is ending. The whole idea that over time the computational power will keep increasing, and if you apply that also to like storage and network speed and things like that, like there are certain walls we're hitting that are not going to be scaling at the same rate or at all. And there's also new technologies like there's quantum computing, which I think is really exciting. There are new mathematical methods for encryption technology, kind of trying to fend off the risks of quantum computing and its attack on traditional encryption. But I think that there are exciting, and there's a lot of things going on in the world of physics and hardware and robotics that I think there's some core technologies today, not so much that a small micro fund like Differential can invest in at this point. But it's exciting to see, to be watching those technologies develop, because all of them will need software. So like looking at, we have a really interesting quantum computing software company in our portfolio, which is both adding value now in the kind of pre-quantum era when quantum is still like kind of in the toy phase in the cloud, and preparing itself for as it emerges into more scalable computing. But so seeing like the software industry around that, seeing the software industry around certain applications of computer vision and of robotics, where the hardware is still being developed and some of the basic scientific technologies being developed, but the operating systems and the software that's going to parallel that development is also being developed. And if you believe, like I believe quantum computing is inevitable, it's a question of when. So if you believe that and you're willing to take a little bit of a timescale risk, then investing in the software infrastructure in parallel early is going to give you a leg up on when the hardware really scales. So I think keeping tabs on, one thing that we like to do, I certainly like to do it, is kind of keep my eye on emerging technologies as they're coming out. We even invest in some of them just because if we understand it well enough, we think we'd be good value-add investors, will invest in it. But knowing what's coming down the pike in technology will help us both invest in things that will be powered and amplified by the development of that technology, but also it helps us avoid investing in what will become legacy technologies once those technologies replace the current state of the art.
So given the depth of your computer science knowledge and also the reality and pulse that you probably have on climate change, political landscapes, we have some major challenges, semiconductor, capital, equipment, shortages and chip shortages. It seems like we have a lot of really quite large problems to solve. Most of your time is probably very exciting and probably really fun to learn how founders are trying to apply unique technologies to solve some of these problems. But just given your vantage point, are you relatively bullish that we can utilize some of this technology to actually come out better than we are today? Or is it a bit sobering to think about kind of the scale at some of the problems that we're still trying to tackle? I know it's a very broad question.
Well, no, but I actually has a simple answer, which is exhibited in COVID. And I think it shows the promise and also the pitfalls. It was amazing to see the scientific community rally around the pandemic. And there are diseases which we've been looking for vaccines for decades. And there were predictions it would take 5 to 10 years to come up with any vaccine that could be deployed to solve this problem. And the scientific community did an amazing job of finding multiple vaccines using different technologies. So it wasn't just like one technology. There were actually I think 3 different approaches that all of which bore fruit and produced, viable vaccines. So that was on the positive side of showing that, if we could convince ourselves we're in jeopardy, and that's one of the key things with climate change is, we don't have people dying of a disease in front of us from climate change. We have this very gradual process, which might have other explanations to some people. So I think that finding the urgency is really a problem. But I think COVID proved to me, at least, that if there were demonstrable urgency for a problem to be solved, that the scientific community would rally around it and probably be able to solve it unless it's an unsolvable problem. On the flip side, seeing the way that the vaccine was politicized on all ends of the political spectrum globally, and how it failed to reach people that ought to have been clamoring for it, again because of misinformation and political motivations. And again, there are lots of perspectives on these things, but I think it's hard to argue that there's a vaccine that saves people's lives that too many people haven't taken. And so I think about it and I worry that we'll actually solve some of these problems that are imminently damaging us and then have the solutions fail to be deployed. And so, we could lose a lot of different ways. I like to have faith in humanity and think that, God has a purpose for us and that, the purpose is not for us to all die of a pandemic or to burn our planet out. But at some point, human beings have to collaborate. We have free will and people have to make good choices. And, with COVID, we've seen people make a lot of not such great choices from my perspective and had some negative consequences as a result.
So every podcast I ask one recurring question about what you think may be underestimated in the world today, and if there's somebody actively addressing that. And it could be totally random, unrelated to investing or your career. I know you're personally passionate about education. So I was kind of curious if there's anything that you feel personally is underestimated today.
Yeah, I think that people are overestimating our ability, human beings' ability to evolve quickly enough to absorb the use of technology. I've been very involved with the Center for Humane Technology and was one of the funders of the Social Dilemma documentary and very, very passionate about the concerns around the ways technologies are being used in society, both harnessing human behavioral data and just influencing people, children at a young age. I've been reading a lot about the dopamine effects of addictions to smartphones and how it's actually become like a chemically measurable addiction to your phones. And I think that we just give ourselves too much credit that we think that we can manage societal change. We throughout the period of history, that we have documented, we've seen enormous changes from the Industrial Revolution. A lot of the globalization we've experienced, the introduction of computers and information technology, and I think that we have, by giving us a device in our hand that is similar to the device on our lap, that's similar to the device at our desk, and the lack of a break, the permanence of that influence, and the way that the companies that make those products and make the software on them are motivated to maximize our screen time, maximize our attention, maximize our use of them. I think that we're not understanding we're underestimating the damaging impact of that. It's already had a damaging impact on a generation, and it continues to repeatedly have impact on generations. I have 4 kids, and one of them was born before the iPhone, and the other ones were born as different technologies were introduced. And I see the marked difference in attention span at different ages of my kids based on how early they got an iPad, how early they started watching, instead of watching video on a TV versus watching it on a phone or on an iPad. And that constancy of information barrage and the ability to channel through YouTube videos over and over again and just go from one thing to the next. I think that we're just underestimating the negative impact of that. I think it's going to be, first we have to figure it out, and then we have to recover from it. And if Ready Player One and dystopian science fiction novels don't convince us, I think eventually we'll start seeing the real world effects of it, and hopefully we'll still have time to make changes in behaviors to reverse the effects.
Well, you're making me very happy that we had the opportunity to spend today together and be away from our laptops and cell phones for a bit. So thanks for all of your time today. So if people want to get in touch with you or with Differential, is there a convenient way? I know that there's a website.
You can Google us, we're differential.vc.
Yep.
I'm David at differential.vc, and you can find us pretty easily. And happy to, we're also on LinkedIn and Twitter, all the poisonous social media sites. So you can find us there, and happy to hear from people. And if people have companies to pitch or have ideas or just want to talk about our portfolio, I'm happy to be chatting with people.
Excellent. Well, thank you so much for joining me today. I hope we can stay in contact, and good luck. And really just so happy we got to spend such a decent amount of time chatting and learning more about you and the fund. And I'm sure we'll have time to talk again soon. So thank you.
Really appreciate you having me, and looking forward to talking again.
Thanks.